When you look at any candlestick, you see a body and two wicks, and at the very top of that candle, there is a point where price reached its highest level during that session. That point is called the high price, and it tells you far more than just how high price went. The high price shows the maximum buying pressure, the highest level buyers were able or willing to push the market before sellers pushed back. Think of the high price as the ceiling of the candle. It marks the moment when buyers say, "That's as far as we can go," and sellers replied, "This is where we take over." It's the limit of bullish power in that specific time period. Here's a real-life analogy. Imagine jumping as high as you can. For the moment you hit the peak of your jump, your absolute highest point, but you can't stay up there. Gravity pulls you back down. The high price works the exact same way. It's the market's highest jump, but Wicks shows how quickly price came back down after reaching that extreme. The high price becomes even more powerful when you look at it through the lens of market psychology. If a candle reaches its high and then closes far below it, that upper wick represents rejection. Buyers try to push higher, but sellers slapped the price back down. That wick is not random, it's emotional evidence of struggle. Buyers losing strength and sellers stepping in. But if the candle closes close to its high, it tells a different story. That means buyers held control throughout the entire session. They didn't just test the high, they dominated it. Strength stayed all the way to the close. In a trend, high prices form the peaks of the market structure. A bullish trend creates higher highs, showing that buyers are constantly able to push price to new ceilings. A bearish trend forms lower highs, showing sellers keep pushing price down sooner and sooner. High prices also reveal liquidity, one of the most important concepts in advanced trading. Above every major high, there are stop losses from sellers and buy stops from breakout traders. Institutions know this. They push price into these highs to grab liquidity before reversing the market. The high price is often where liquidity is resting, waiting to be taken. Let's make this simple with another analogy. Imagine a group of people hiding money on top of a shelf. Everyone knows the money is up there. Eventually, someone jumps high enough to grab it before running back down. That jump, that's the liquidity sweep at the high. The session high is especially important. The daily high, the weekly high, the monthly high. These highs act like magnets because traders place stop losses around them, and institutions target those stops to fill large orders. Even inside a single candle, the high price reveals a lot. A large upper wick tells you sellers came in aggressively. A small wick suggests a confident control move upward. No upper wick at all is pure dominance from buyers with no pushback. The high price is also key in patterns. For example, a hammer has a small upper wick, meaning buyers didn't push high. A shooting star has a long upper wick, showing strong rejection. An engulfing candle's high matters for confirming strength. Now, let's look at how traders actually use the high price in real time. Suppose the market is approaching yesterday's high. That level becomes a battleground. Will buyers push above it and start a breakout? Will institutions sweep and reverse the market? Will price respect it as resistance? All of this depends on whether price can break and hold above the high or gets rejected. In smart money concepts, the high price, especially a swing high, defines structure. A break above a major high with candle close confirms bullish structure. A wick above but close below is a liquidity grab. This difference determines whether traders expect continuation or reversal. Let's wrap this into one simple story. Imagine a candle climbing during the session. Buyers are excited. pushing higher and higher. Then they reach the high price, the absolute peak. For a moment, the market pauses. Sellers test the strength. If buyers can't hold that level, price falls and the wick forms. That high becomes a clue, a reference point, a psychological ceiling. But if buyers stay strong and close near the high, that ceiling breaks and becomes motivation for continuation. To summarize, the high price is the maximum price reached during the session. It represents the limit of buyer strength. It signals rejection, continuation, or liquidity behavior. It forms the peaks of market structure and is critical reference point for intraday, swing, and smart money concept traders. The high price isn't the top of the candle. It's the peak of the session, emotions, intention, and strategy. Understand how price behaves around highs, and you understand where market highs liquidity, where it reverses, and where it breaks into new trends.